All right, I'm just doing a little light rabbit holing today on hedge funds. Um, so yeah, I'm just got super curious about what hedge funds are all about. So first of all, I'm just gonna see. Gonna get some of the basics out of the way here. First of all, I'm gonna get that too big. Pooled investment fund that trades in relatively liquid assets is able to make extensive use of more complex trading, portfolio construction, risk management techniques in an attempt to improve performance, such as short selling, leveraging, and derivatives. Financial regulators generally restrict hedge funds marketing to institutional investors, high net worth individuals, and accredited investors. Accredited investors always gets me. It seems like just such a scam. An accredited or a sophisticated investor is an investor with a special status under financial regulation laws. The definition of an accredited investor, if any. Generally, accredited investors include high net worth individuals, banks, financial institutions, and large corporations. That's funny to me. So I'm just going to sell. Oh, we got right on top of the. 20 largest hedge funds in the world. Assets under management. Okay. It's interesting. It's only London in the United States. I guess. Just want to get a feel for the size of how big. This is also not just the, so that's 1 trillion, I think, or that's millions of US dollars. Oh, that's not that big. Wait, 834. So 834000. I just got a 0000000. Gotta figure out that. What's that? That's 834 billion. So it's almost $1 trillion. And as we figured out before, just to put that in, USA GDP is 23 trillion. And then if we just look at want to get a feel for how big these are. So the biggest ones are 22 trillion. So it's relatively small. I mean, let's say all this market cap's about 100 trillion. Hedge funds about 11 trillion. Well, so hedge funds about 1 trillion. So we'll just get some. Yeah, it's not too big, really. I mean, it's big, but it's not like, it's still relatively small. So Bridgewater Associates, Man Group. Bridgewater's pretty big. They're not that, honestly, they're all kind of a similar size. So there's probably, I'm sure there's probably quite a bit more than 20. This distribution that's like kind of all the same. Like most times when I look at distribution, like if the top one's 126, the 20th one would be like not even 1, or not even like 1,000. So that distribution is tight, which is interesting. But that tells me that there's probably a lot more hedge funds that are doing, like, this is 23 billion, the 20th. So I gotta find, there's probably gotta find a better list. But I do want to get a feel for, because it's gonna be like, so Bridgewater, Man Group. I'm gonna look at the United States one just because it's just gonna complicate things a little bit if I don't. David, 2 Sigma. Bridgewater first. Ray Dalio, I've heard of this guy. The firm's history includes a pioneering industry strategy such as currency overlay. First of all, I want to see if they actually make money. So, Bridgewater Associates in Connecticut. Yeah, let's see. Well, let's first see if they make money. So again, 126 billion is how much? 126 billion. That's pretty big. That's a lot of money to be managing. But it's not like crazy. So like some of these big mutual funds would be 260. These are just all Vanguard. So this Vanguard. Basically just all a bunch of Vanguard funds. Jeez, it's all Vanguard. Fidelity. I'm curious. It's funny to me. So just, I generally think of mutual funds kind of as scams. And so I'm not sure how to think about hedge funds. I would guess probably just even worse scams, but maybe not. I've never understood why anyone would take money from another person if they know they can make money on it. They should just use their own money and take a loan. So I know I've looked into some hedge funds before. I know like the ones that do the best, they don't take money from people. It's just them managing it. But anyway, so let's look at, I want to see if Bridgewater makes money. So Bridgewater Associates. So when was it start? 19? Returns by year. Stock Circle. I'm not sure where to look that will tell you the truth. But let's look. This looks awful to me. So dang, why is it not? I want to see all of it. So hedge follow. We can't just give me the numbers, so 3-year annualized return, 3-year cumulative return. Over what time period is this? It's just not good information. Like, let's, okay. Here, maybe Wikipedia will say it. Does Wikipedia say it? They've been around for 48 years. With 1,500 capital. $2017. Pension week. Gotta figure out the returns. Bridgewater Associate. I guess they have like multiple funds or whatever, but you know. Pure Alpha All Weather. Returns by year. Let's see what'll give it to us. Blah, blah, blah. Blah, blah, blah. Maybe some images will help. There's 91. Bridgewater Pure Alpha, but that's since 91. It's like basically the same as the market, maybe a little less volatile. Right here, I guess it would look good. But again, this is just one of their, so if they have like multiple funds, it's kind of confusing because I guess if you're a hedge fund, you can always just create new funds. So like if one doesn't do good, you just create another one. Let's see. How could you do this? Let's see. I wonder if I have to pay. Seems like such an easy thing to get. Okay. I guess I'll just think about the past 10 years. How much have they made in the past 10 years? 10-year performance is 22.86. So that seems quite bad. This information, I have no idea what I'm looking at, to be honest with you, because it's like, I don't know, Ray Dalio Performance Bridgewater Associates Portfolio. But 22.8% over 10 years is just not good at all. It's 2.2% per year. And over the, I mean, let's look at like the NASDAQ 10 years ago would be like here. Now it's here. Yeah, I mean, it's like, even if it's here, I mean, that's like what, 13 times like 5, it's like 500%. So to only make 2% per year for the past 10 years, you're basically just losing money because of interest. That's crazy. Here's the other way to look. So my big question is, so if you're a big hedge fund, how do you and you're not like even close to the market. I just don't understand why anyone would invest in you. I think a part of it is honestly, I think rich people feel like they have because they're an accredited investor, it's almost like a marketing play. They feel like they're special, and they have inside information, and so they're like, oh yeah, I got in with Ray Dalio's fund, but it's not really like good at all. It reminds me of there's a Larry David where Larry gets told that apparently it's like going around in celebrity circles that there's going to be a terrorist attack in LA that weekend. And it's like, I think there's like some trust among rich people, but sometimes it's like just as dumb as anything else. I bet hedge funds really leverage that, to be honest with you. So Man Group Renaissance. Let's see if Renaissance. I feel like I've heard their name. Oh yeah, this is an interesting one. I actually looked into this. So Renaissance as Rentech is an American hedge fund based in New York, along with systematic trading and quantitative models. Their signature medallion fund is famed for the best record in investing history. So they have a fund that is working. Renaissance was founded in 1982 by James, a mathematician who has formerly worked as a codebreaker during Cold War. In 1988, the firm established its most profitable portfolio, the Medallion Fund. So that's in 1988. I was born in 87. It's 1 year, so 34 years ago. Spanning from... I just have to say, as a side note, like, I am totally not impressed by any sort of math that is done in the trading world. It just doesn't seem like a real thing. It seems like a marketing ploy. Like they use big words like quantitative modeling. It's statistical analysis. But like, I don't know, what is their... I don't know. I'm suspicious of it. I think you have to have like resources that other people don't have is what I think. But Renaissance flagship medallion fund is mostly for see, this is the medallion fund does make money, but it's an employees run it fund. It's famed for the best track record, returning more than 66% annualized before fees. I mean, that is nuts. So they're not like trading. If they're getting 66% before fees and 39% after fees over a 30-year span from 1988 to 2018. Of course, you know that okay, but I wonder how much these make, the ones that are for outside investors. Renaissance. Firm uses quantitative where staff tap data into petabyte scale dataware to assess statistical probabilities from the direction of security prices in any given market. Staff attribute the breadth of data on event peripherals to financial and economic phenomena that Renaissance takes into account and the firm's ability to manipulate large amounts of data. This is interesting. I mean, I believe they can do some crazy stuff with data. I'm not crazy stuff, but if they've been getting like tons and tons of data, like you get all the like second level tick data for every trade, or like even more than that, not even the second level trick data, but like every order that gets put in, and you have all that, and you start analyzing it. If you have just tons and tons of data, you can definitely start getting like, you can figure out how to get a little prediction on the market, and you can probably make a lot of money. And I bet they're just doing that better than anyone else. But the reason they're doing it better than anyone else is pretty clear. It's because the people who are running the firm or running that fund are getting the money back. And also, I've looked at this before. The Medallion Fund. Yeah, the fund has been closed to outside investors since 1993 and is available only to current and past employees and their families. The firm bought out the last outside of investors, so they don't have any outside investors. About 100 of Renaissance, some 200 are qualified, meaning they generally have at least. What's the size of the Medallion Fund? Yeah, it's 130 billion. Or wait, no. That's how much they own total, but so the Medallion Fund is not. It's only like a pretty relatively small portion, I think. I found this before, but I guess I'm not sure exactly. It says amount of medallion, which includes leverage amount. I don't know if it's that big. I heard it. I think it's only like 10 billion. It doesn't say now. It used to say. Always look at history. People like to remove stuff when it starts to work. Let's look at this, 2016. That is not correct. That's Renaissance Assets Under Management. That's not the size of the medallion fund. I bet Renaissance kind of wants to. Oh, there you go. Renaissance 10 billion medallion fund. See, I thought it was 10 billion. Renaissance 10 billion medallion fund gains 24% year to date. So that's fine. I've researched this a little bit before, and I remember running across that number. The medallion fund, they cap it out at 10 billion. So it has really good returns, but only up to 10 billion. Which is still, I mean, it's a lot, but it's harder. I bet it's harder if they start managing like 150 billion. I'm sure it's harder to make more money. Like, it's harder to make those same returns on and they manage 150 billion. So it's like, you know, like not even a tenth of their portfolio. I'm just getting the spell out wrong there, but so it is interesting though. What are their other funds? Let's see, I wonder how their other funds do. Probably not as well. Medallions, Renaissance Institutional Equities Fund, REF. This is a great idea to be a hedge fund and have one good fund that you guys make money from and another fund that this 3 years is totally worthless. Nobody cares about 3 years. So Yahoo Life, this is just going to be spam, I bet. Spam. My charts, but it costs money. Renaissance give us the information? I doubt it. What I'm looking for is my prediction is that their other funds don't do near as well as the Medallion Fund. Jesus Christ. I mean, if I'm looking at these right, I mean, these numbers are like totally measly, right? 5 years, you're making 1%. So 5.2% over the 5 years. So you're averaging 1%. Some of these don't even have, and it's like getting worse. So this, I don't know. I can't really read these numbers. They don't really make sense to me. But nothing looks... They look like low numbers. Let me see. Have any hedge funds outperformed? I guess it depends on who you ask. If you ask the S&P 500 index, they're going to say no. If you ask a hedge fund, they're going to say yes. It all depends on the time. Let's see. Let me just be biased on both sides. So this is like way too short a time. Doesn't Warren Buffett have he has a hedge fund bet. Buffett's bet with hedge funds. In 2008, Warren Buffett issued a challenge to the hedge fund industry, which, in his view, charged exorbitant fees the fund's performance couldn't justify. Provide Partners LLC accepted, and the two partners placed $1 million bets. Buffett has won the bet. Fund's performance couldn't justify. Oh, okay, so one of the hedge funds. And two parties placed. Okay, yeah. Okay, I just want to see what bet he made. I kind of believe Warren Buffett on this. So in the last. Okay. Bang to design using a platform called Long. Okay, Warren proposed like a preposterous bet. He believed that over the next 10 years, active investment management by professionals would in aggregate underperform the returns achieved by rank amateurs who simply sat still. Okay, well. It's kind of not what I mean, if you take the average hedge funds, obviously not. But the question is, are there some good hedge funds? I mean, the reality is, and so the Medallion Fund, because, I mean, you can create a system that beats the market, I think, through like doing a bunch of sort of crazy data analysis and just like doing lots of trades. I mean, I know you can. I do. I run like I trade stock news, and I'll beat the market, but it's not like I can't scale it up It's a lot more volatile. And the strategy would like there's like little technical strategies I think you can get to make money, but so let's look at I still want to figure out millennial management assessment hedge fund offerings on the world's largest. LLC. Annualized returns. Hedge Follow just managed us to give us there's like all these. I couldn't care less about 3 years. Let me see. I wonder if ChatGPT can tell us anything interesting, because the internet can't. It's going to be a hard one for them to. Yeah, they're not giving us much. It's not going to be able to tell us. There's something. I love how there's always like, it's impossible. It should be so easy, you know. You have a list of 30 years and then the return for every year. But you can't get good information on the internet. You should be able to. You could, but it's hard. The fund has returned 2.4% over the past year. What? Here. 11. Okay. 2012. The fund has returned, okay, the biggest piece of data is 11.23% over the past decade. That means it's less than 1%. So it's just awful. I don't understand how anyone invests in these funds. That's my big question. Like, what are they doing to get people to invest? Let's Google it. Why do people invest in hedge funds? Here, I'm going to search in the negative sum. Hedge funds. Are hedge funds scams? We got Vox. Let's see what people on Quora say. Let's see what this guy says.
Hedge funds are a scam. That's right. You heard me. Hedge funds are a scam. Today, I'm going to tell you why. 9 years ago, Warren Buffett challenged the hedge fund industry. And somebody stepped up and said, all right, I'm going to take the aggregate of 5 hedge funds. So we're going to pick 5 hedge funds, put them together, take their average performance, and we're going to put it up against Warren Buffett. You know what product Warren Buffett chose? Vanguard S&P 500 Total Market Fund. You want to guess who's winning that bet? 9 years later. 9 years. I get it.
Okay. It's not very true. I mean, you can have, if you take the average of hedge funds, that's fine. But like, the big question I would have is, are there hedge funds that are legit? The answer is yes, in my opinion. You have the Medallion Fund. But then the question is, why would anyone let you in? And I think the answer is they wouldn't. Here, let's check out Reddit. First of all, are hedge funds scam? Most hedge funds are not scams. So 97% deliver returns that are below benchmarks due to the high. So %97 of them failed to beat their benchmarks. Only 3% beat their targets over a 3-year period. 3-year period is also nothing. That's just like, I don't know the exact math on this, but that's startlingly low. Like you'd think just randomly, like at least like 20% or something would be. The prevailing wisdom on Quora is no, but again, like all these people just work at a hedge fund. Like, let's check out Jeff Rowan. What's he up to? I mean, why are you answering Quora questions in the first place? A practitioner of science and logic. He's a big proponent of basic income. My question is, why is anyone on Quora answering 4.4 thousand has 4.4 thousand answers? You must be some sort of content creator. Or it's just ChatGPT hooked up to Quora. Quora's weird. Like, who are these people answering on Quora? It's just like content creators, but I think it's a Quora user. Again, 1.5 thousand answers. Yeah, they're just doing like SEO stuff. So I'm guessing they probably get paid. I'm guessing they, like anyone who's putting answers on Quora, they probably like will answer a ton of questions that are like related to a market, and then like spam some links, like 1 out of every 10 or something. So like you won't see it always, but then like a good example is Kendra Morgan. I'm sure she works probably in the marketing field and maybe for like an agency. And then every once in a while you just spam. I know, because I've done a little bit of this. But yeah, this is just god awful information. Content creators give the worst information ever. For a while I've enjoyed the degree of confidence. It's kind of an interesting way to phrase it. For a while I've enjoyed the degree of confidence in his view expressed by Warren Buffett's $1 million bet that an index fund could beat a portfolio of hedge funds. And I felt it indicated pretty strongly that hedge funds weren't all that great. That combined with learning more about the costs associated with active management as opposed to passive management for hedge funds, I figured hedge funds probably were a questionable investment at best. I found out more recently, though, that not only is Buffett winning the bet, he's winning 64-21. Not only the hedge funds losing the market. This is a dumb way to think. Thinking too much about this bet is stupid. I mean, it's just random. It's so much randomness involved. You could have easily picked 5. I mean, not easily. He's right to make the bet, because if 97% are underperforming, it'd be very improbable that you pick 5 that overperform. The simplest way to change my is not show me the market. No. To me, the question is like everyone's concerned about the average of funds. To me, that's not the question. Like, if you look at day trade, so I mean, day trade. It's like looking at businesses. Like most businesses fail. It doesn't mean business is a bad idea, though. This is the success rate for day traders is going to be about only 10%. So I've heard this number to be much lower. This says 1 to 20%. I bet it's low. I bet it's like 2%. But that means you like nine. So only let's even if it's 10% day traders, I think it's lower. I bet like only 1% day traders make money. But I think the 1%. I've looked into this, and there is 1% that they consistently do win. So it's like there are some that are winning, but it's the Pareto distribution. I think I always call it just the Pareto distribution. But it's a very real thing. So I would expect only about 1% to make money, and they just take it from the 99 other percent. It's a zero-sum game, so I would totally expect this. But if I think the hedge fund market would be a similar thing. What else am I curious about here? Let's see. I think if you make money over 30 days, I don't care about 30 years, you have a good strategy. Also, I just have to comment on the medallion fund. I bet it's a good fund, but if you start doing I think, in my opinion, this strategy that they have is going to be harder. It's going to get harder and harder to maintain just because there's going to be a lot of other people coming in and doing like the little data, basically like, just high frequency data trading type thing. And so if they don't have like monopolies or like certain things set up, which they probably do, I'm sure. But if they don't, and if it's just like analyzing and processing data, that medallion fund is not going to be able to continue that performance, I don't think. I bet they're able to do it because they just like figured out that, hey, we can use a lot of computers to help us trade. And nobody else did, but now it's like everyone knows that. And I'm sure they're just using like statistical models. I mean, I'm sure they're big statistical models, but like there's people who are probably going to get better. But anyways, we'll see. Put it this way, I would want to be in their shoes because they're cleaned up, but the other thing, I don't really care about this. This is just like, yeah, so none of these funds beat the S&P, but that's not surprising at all to me. That's exactly what you'd expect. Okay, this article, to me, it's like, anyways. Yeah. Oh, that's interesting. So, So it says Barclays Hedge reported that over the past 5 years through 2021, the average hedge fund in the universe produced net annualized return of 7.2%. Barclay Hedge, okay, with a Sharpe ratio of 0.86% and a market correlation of 0.9%. That's like super high. It's that market correlation. The later point suggests the average manager purchased. The top 50 funds, so looking at the top 50 funds, return annualized gains that were more than twice the industry's average over the past 5 years, 15 point, having trailed a raging bull market by just 3 percentage points, and having nearly kept pace with the S&P 5. So still the top 50 funds aren't beating the S&P 500. It says they did so with significantly less risk and correlation. So between 2000 under 2, well, this was over 15 to 50 average worst. So here's my other thing. So, like, it doesn't look like these hedge funds are beating. Oh. There's got to be, like, some decent hedge funds, though. Where's this people getting this information? I want this raw data. Dalio's Pure Alpha Fund is up 30. Jesus Christ. There you go, 10 years annualized performance. Wait a second, what does annualized performance mean? Is that your average over... Is that the average? That's the average per year? It's a measure of investment performance over a period of time, typically 1 year. This is expressed as a compound. Okay, so yeah, that's I'm not sure why we're starting at 4. I'd like to see the top 3. One Wellington Fund, Global Fixed Income Fund, Tactical Trading Fund. Those aren't the top. I mean, 24% is pretty good over 10 years. But I think the thing with 10 years is if it's like 10 years is still pretty small. I have the I think like at 15 years, you like probability sets in, and so like randomness, it just becomes impossible to be doing good. What? This is the top 10. The S&P has blah blah blah. Meanwhile, funds with outperformance, blah 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 blah. Nothing interesting. So whenever he wrote this, it looks like annualized, it was, let's see, 14.7 would be the, so you do get funds that are beating it. 10-year, but also like the S&P has been doing really well. 14.7%. It's really tricky because, like, if you're analyzing these things, I think because like if let's see, well, forget the S&P, let's just look at what am I thinking, the Dow maybe? When did the Dow start? 1988, it's far enough away. Yeah, it's kind of tricky to think about, because you also have to think about, like, if it's just going up, periods like this, you're gonna be able to get like some higher risk hedge funds that just like leverage your money like crazy, and then they'll just make more than the market. But then when they go down, they'll make less than the market. But I think one of the claims is that the hedge funds take less risk than like just putting your money in a S&P 500, which is important. But I just kind of am suspicious of that because, like, I guess the question becomes like how much market correlation is there, and it's probably like if it's 0.9%, it's just super high. And it's not risk, it's volatility. You take less volatility, but you're taking the same amount of risk, in my opinion. I consider risk to be like, basically, if you have your money in TD Ameritrade and you're trading, I consider volatility to be like, maybe it'll go down 20% on a day. That's volatile. I consider risk to be like the CEO of TD Ameritrade, like running away with all the money. That's risk. And I think the risk is the same or more when you're in a hedge fund. The volatility maybe is a little less, but I think if you're going to put your money in the U.S. equities, I think it's always basically the same risk. The only question is who you put it with. And if it's a hedge fund, you have to calculate in the risk of the hedge fund manager running away with your money or other shenanigans. So what's the... What fund did Bernie Madoff own? I want to see, was Madoff Madoff Investment Securities LLC. Was this a hedge fund or a... The Madoff investment scandal was a major case of stock and securities discovered in former NASDAQ chairman and founder on Wall Street admitted that the wealth management of his arm. $50 billion. So there's like this another class of... Here's what I need to understand. Like, hedge fund, like what else is there? Versus mutual funds versus private equity. But I need to understand like what types of funds are there in the financial industry. I don't even know that. So types of funds. Let's see what there are are many different types of funds in the industry, each with their own investment. Okay, yeah. You got mutual funds, ETFs. I'm familiar with those. You got hedge funds, private equity funds. What else we got? Real estate investment trusts. Okay. Money market funds. Index funds. I knew about all these. What type of... I'm just curious. Let's see. What type of fund? Maybe it's just like a... Okay, it claimed to be a hedge fund, so that's the key thing. It says it was not a legitimate type of investment fund. Well, at the time it was. So it claimed to be a hedge fund. So hedge funds, yeah. Owners, how much fees? Or, here's the question. How do hedge funds take fee or charge? Like, I'm sure it changes, but I'm sure it's different, but I'm sure they don't do it on performance. So there's the 2 and 20. It sounds like it's common. Hedge fund management companies typically charge clients with a management fee, 2% of assets under management. 20 refers to standard performance. Oh my God, are you kidding me? 20 refers to standard performance of incentive fee. 20% of profits made by the fund above a certain predefined benchmark. Okay. Is that yearly though? Two refers to standard management asset. 20 means the incentive fee. 20% of profits above a certain threshold. Holy cow! 1 second. I gotta get this down. The 2% management fee is paid to hedge fund managers regardless of the fund's performance. A hedge fund manager with, I understand. The 20% performance fee is charged if the fund achieves a level of performance that exceeds a certain base threshold known as the hurdle rate. The hurdle rate could either be a present percentage or may be based on a benchmark such as the retail. What I'm trying to understand is the time period, because that's the only important thing. Some hedge funds also have to contend with blah, 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 2 and 20. So... What is the 2 and 20? The 2 and 20. It's the biggest source. The 20% performance fee is the biggest source of income for hedge funds. The performance fee is only charged when the fund profits exceeds a prior agreed upon level. A common threshold level uses 8%. That means that the hedge fund only charges 20% performance fee if it profits for the year surpasses 8% level. That is nuts. Just gotta, like, the thing that's so interesting here is you get that 20% after, so they get 2% off the top, and then 20% if they beat some yearly rate. And that to me is the crazy thing, because like the shorter this time period is, the better of a deal it is for the hedge fund manager, because you're going to get just volatility, especially in a year. Like it just all depends on the market. So the more volatile the market, the more money you make. Like the only thing you don't want is like kind of a non-volatile market, or if the market goes down, but you don't really care because the market's going down, you're not gonna make any money. So that's a crazy structure. I just can't believe so. Yeah, that's nuts to me. I can't believe anyone investing money would take that deal. It's like, let me tell you, these hedge funds, they don't have any sort of, I mean, that's just so crazy. I don't know how they get people to buy into that. I mean, there's $1 trillion in hedge funds. There's no way they do. Oh, really? How you could make money copying hedge funds? You could also copy mutual funds. Mutual funds definitely have to. Hedge funds with over 100 million assets must disclose their holdings approximately 45 days after the end of each quarter. Wow, that is a big ad. So you could copy a hedge fund's positions, but again, it's hedge funds with a. It's not like. I mean, first of all, who cares about the hedge fund's positions because they're not any good, right? But well, maybe that's kind of an interesting. Hedge funds with over 100 million assets must disclose their holdings approximately 45 days after the end of each quarter. This is done via an SEC. So if there's a hedge fund who's consistently winning by just holding like equities or something that you can buy, by buying, like going long for a long period of time, instead of, like, if that's their strategy, which yeah, here's the copycat trade. It's worth nothing to bet. You actually have to an edge. Yeah. So you could just copy it and not pay that 2%. But the reality is, I'm guessing if you're a hedge fund, I thought you'd be doing like a lot of day trading, not just holding. If you're just like holding positions, I don't know. I don't understand why you. But there's a lot of ways you can copy different people's trading strategies. But I feel like, it's not going to be that amazing. So what else is interesting? I just can't believe that they get away with charging 20% over the certain percentage. If anyone wants to give me their money, I'll make a deal. I'll do my best. And if in a year it makes more than 8%, and I get to take 20%, that's a good deal. Look, I have a trading strategy. how much some of my trading strategies make. So let's see. So that's about 0.5%. So yeah, that's higher than 0.5% over 2,000 trades. So bum 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 bum. So I made. Wait, how much is that? Yeah, that's the total. That is 1,459% over 2003, 2001. How many months is that? One, two, 45 months. So that's what, like 3 years? 12. Oh, 3.5, almost 4 years. But so my annualized return would be, I'll show you my annualized return. That's my annualized return. 389% over almost 4 years now. Did I do that math right? That seems like a lot. That's the total percentage. Yep, that's right. Yep, 389% annualized return. So I'm beating the medallion fund by like a lot. A lot. How do I do it? I trade a bunch of news. But I don't trade for large amounts of money. Like if it was a lot of money, I wouldn't. It would be harder to make money. Boy, I didn't know I was doing that good, to be honest. I guess I knew I was making about 0.6%, about 0.5 percentage per trade, but I didn't realize I had this many trades. That's a lot. And this 389% is really good. Why do I feel like, did I do that wrong? That seems too high. So this is my average, and this is the total number of trades. And so, yeah, that's right. Total number of trades, average. I multiply the total number of trades. So this is my total gain. That's over that many. Yeah, that's it. But anyway, so you can definitely figure out systems that make a lot of money. But when you start trading with more money, it gets harder. Boy, that's better than I thought. I need to put more money in my system. But the other thing is, it's like if I have the system, I'm not gonna let anyone else in. I'm just gonna do it with my own money, because once you hit that cap, it's like, okay, now you hit a cap. It's hard to make more money. So, and the medallion hit that cap at 10 billion. That's why they can't do more than 10 billion. I'm curious about 2 Sigma. And I'm just some schmuck too. I can program, so I can set up automated systems, but I don't have any inside things. So you should be able to build a decent hedge fund. That's why I'm a little surprised there's not more like cases like the medallion fund. Oh, they use artificial intelligence. 2 sigma. I just want to get 2 sigma. Oh. Jesus Christ. Net annualized returns average are slightly above 30% from 2009 to 2014, so that's good. I did. Okay, yeah. You hear a lot about, so this person just asking the question. But anyways, let's say it's making 30%. It's closing in on that 30%. It's still pretty good. I mean, it does matter because if they're doing that, then it's like, okay, it's good. I would be interested in investing in them. Okay, so over the past 3 years, it's not been nearly that good. This is what always happens. Like, you can start a hedge fund and it does fine for a few years, and then you get a bunch of money, but you're not going to be able to hold it. You just got lucky. It's called getting lucky. 3 years annualized return, 6.92%. Although that's still not terrible, to be honest. But if they have, so what was it called? 2 sigma. Fee structure. Yeah, so they have the 2 and 20. Wait. Come on, little thing. Open up. The other thing is, so again, so there's this Sharpe ratio, and I understand it a little bit. Here, let me Google real quick. Sharpe ratio, the return of the portfolio. Ooh, I don't love that way of calculating it. Is the reward to variability ratio. Measures the performance of investments such as a security or portfolio compared to a risk-free asset after adjusting for risk. It is defined as the difference between the returns of the investment Okay, suppose an asset has an expected return of 15% in excess of the risk-free rate. I don't know what the risk-free rate is. Returns of 12% and a standard deviation of 10%. What is the risk-free rate of interest? Okay, I usually just don't even, I don't know what this is, but let's just, the risk-free rate of interest. I think you don't even, you generally don't even think about the risk-free rate. Basically, my understanding of the Sharpe rate ratio is your expected returns. So your expected returns, so if you make like 10 trades and each trade makes, on average, well, like, let's say each trade makes $2, then your expected return is $2 on 10, so 20%, right? And then you just multiply that by the standard deviation, which is the important piece. So it's basically just your expected value over the standard deviation of all the trades. So that's the Sharpe ratio.
You can't see me, right?
We'll see ya.
Huh?
We can see ya.
He's naked.
You can show it off on camera.
I'm not trying to.
Okay. Here's one. So. So one thing I'm curious to see, so here you go. Here's a good test, I think. If you look at, so looking at what happens to these, because like, so supposedly a lot of these hedge funds, one of my questions would be, so, yeah, I still haven't find a fund I could potentially get in that has EV, expected value, that beats the market. This is kind of what I'm thinking about trying to do, right? And the other option, but the other thing is, the other thing to think about, it would be, you know, find a fund that is close to the market with much less risk. I don't even want to say that. With better Sharpe ratio. The thing about like risk is, again, I don't believe it. I think what they're calculating with the Sharpe ratio isn't risk. I think it's volatility. And I really view those concepts as totally different. And I don't care that, no, who cares about volatility? Like, volatility doesn't matter. Unless you're investing for like a day. Even then it doesn't matter. Just make a lot of investments. Like, nobody cares about volatility. That's why your Sharpe ratio doesn't matter that much, because it measures volatility. You can't measure risk. I don't think you can measure risk. That you have to use that's how I would separate it. Volatility you can measure. Risk you can't. That's like axiomatically how I would define the difference. But most people are concerned about risk, not volatility. But here's some curious questions. So like, after COVID hit and the whole market drops, let's look at these funds who supposedly like, have less risk, right? So let's take the biggest one. Well, it's hard to see. So I wonder if there's like an average hedge funds chart. It's like an index fund of hedge funds is kind of what I'm looking for. Index fund of hedge funds. I probably don't have it. It's going to depend on the hedge fund strategy, though. Okay. Oh, God. I don't know what I'm looking at. Let me see. Yeah, there's no great way to get this data. Let me just look at one. This is from them. I guess their performance probably isn't really public information. Oh, here you go. So that's the we have the drop. Ooh, I wonder if we could just. So yeah, we still get a good drop there, but. Cumulative returns negative 9.2 in quarter 2020, quarter one of 2020. Yeah, January, February, March. Yeah. I mean, that is quarter one, but then it comes back up. I don't know when their quarter comes. So it goes from 10, so it drops like what? I'm not sure how these. But anyways, there's definitely a big drop. Let me see. Oh, this is interesting. Berkshire Hathaway is a hedge fund. They consider hedge fund. Well, I guess they're not really considering a hedge fund. They're just saying. This is a pretty good chart. Hedge funds. Largest buys. Top hedge funds. Yeah, so these are some smaller ones. That's a lot. Not as good as my system, but a lot. 4.97. I don't understand how the 3-year performance is 250, but the annualized 3-year return is 51%. Those numbers don't quite make sense, right? Yeah, I mean, yeah, you have to look into these, but it's so tricky because you have to like look in and be like, okay, well, what are they up to? Did they just get lucky? I would want to see more than 3 years. Let's take a look at Michael Burry. See what Michael Burry's up to. He's managing $46 million. That's actually not that much. it's like almost not enough to care about. But let's see what Michael Burry's up to. So Michael Burry manages Scion Asset Management Holdings, and he's made $191% over 3 years. Let's see, Michael Burry. You're hot, Michael Burry. You're hot. I don't know what this is. Oh, top 50 sign. Oh, okay. So look, we can see that you can just copy their things. So instead of giving them all your money, you can just copy it. The problem with... Oh, I froze again. Okay, now you guys can see me. You will not be able to see me. Okay. Oh. So I'm guessing that this website's probably just pulling these from their SEC filings that they're required to do. Yeah, because since Q4 2022, otherwise it'd be more recent. So, like, if you're copying these strategies, you want to know that they're holding these positions for a long time. I'm guessing with that, like, SkyWest. Oh, that's a nice little chart. You can see when they bought and then the price history. It's kind of cool. But it doesn't really look like he has, like, it's not like he... I would honestly just think that some of these funds would be better at, like, insider trading, frankly. Why can't they get some inside information? Yeah. I just want to see what Michael Burry's... Michael Burry, how you doing on LinkedIn, buddy? There's a lot of Michael Burrys out there. A lot of Michael Burrys. Michael Burry. How you doing there, Michael Burry? I don't see him. You a real person, Michael Burry? Michael Burry. Scion Asset Management. Oh. He has his own Wikipedia page. That is not the right Michael Burry. He's a physician. Is that right? Physician? He's best known for being one of the best first to predict the subprime. Really? Yeah, to me, it's crazy that there's not hedge funds that are good. Like there should be, because you just assume that so, like if you're just buying all the company, if you're just buying like an index fund, you're basically just taking the average of all wisdom. It's the conventional wisdom, right? But presumably, there's people who are better at picking companies than conventional wisdom. Their model is slightly better. I'm not one of them. Whenever I try speculative trades sometimes, and I just lose like crap. It's like I don't understand. I don't know what the heck is going on. During his payment. Oh, that's not fun. I'm curious. This guy's like no.
Betting against the housing market,
Right, we bought basically short 8.4 billion of credit default swaps related to mortgages or financial companies.
right? Must have been pretty confident this thing was sort of
Well,
blow
we
up.
had a giant bet for us, and I was extremely confident in the outcome.
Were your investors as confident?
Um,
That's interesting.
I'll wave in the back. On our debt, the degree to which we can tax our population is eclipsed by the amount of our interest on our debt. Basically, makes us a Ponzi scheme of some sort, and I think that's the point. I think it's very hard to pick that spot.
All right, I gotta go take care of my baby. This is an interesting person. All right, I'm calling it a day. Bye.